Have you ever made a financial decision that you later regretted and wondered, what was I thinking? If so, you're not alone. Our minds play tricks on us. And today, we're going to uncover some ways that happens in financial decisions and how you might avoid making certain mistakes. I'm Keith Demetriades, and if you've ever wondered why your financial decisions sometimes seem irrational, stick around. We're about to uncover the hidden forces at play. We'll cover 3 different mental pitfalls, how to overcome them, and additional steps you can take to help build the retirement you envision. These pitfalls, called cognitive biases, are mental shortcuts our brains use to make decisions quickly. These shortcuts can be helpful in everyday life, like quickly deciding what to eat for dinner or choosing the fastest route home. Did you know that the average person makes about 35,000 decisions every day? No wonder we feel exhausted sometimes. Too many choices tax our brains and can lead to decision paralysis. Think about trying to pick a new show out of the thousands available on Netflix. You can sometimes spend more time deciding than actually watching. I've been there. As a defense, our brains take shortcuts to keep the decision-making process moving. They make a decision based on prior experience. While these shortcuts can be useful, especially for mundane decisions, they can also lead to significant errors in judgment when it comes to more complex matters, like financial decisions. If you work only off experience and don't account for current variables, you're probably making poor financial decisions. But knowledge is power, and we can outsmart our own brains. Let's talk about common biases. We'll start with overconfidence. We've all been there, thinking we know more than we actually do. Overconfidence bias is the tendency to overestimate our knowledge and abilities. This can lead to some pretty risky financial moves. Imagine you're reading an article about a promising new tech company. You think, I've done my research. This is a sure thing. You invest heavily without considering other opinions or potential risks, only to watch it underperform or even fall. Sound familiar? To quote Mark Twain, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Overconfidence can be our worst enemy, especially when it comes to investing. Here's an example. I was recently talking to a tech enthusiast who told me about how she'd made a big financial misstep. She was convinced a particular technology stock would skyrocket, and she invested a large portion of her savings into it, thinking she had found the next big thing. After a strong start, the market took an unexpected turn, and the stock, it took a big hit due to issues in the company and the tech sector as a whole. She'd been overconfident, thinking she knew the industry so well that her investment was bulletproof, and she wound up with substantial losses and a lack of confidence in her whole investment strategy. A classic example is the dot-com bubble of the late 90s. Investors were so confident that internet companies would grow like crazy that they poured money into virtually any company with a .com in its name. When the bubble burst, a lot of people lost big money because they'd overestimated their understanding of and control over the market. So how do we avoid falling into the overconfidence trap? First, you need to understand that education is key. One of the best ways to combat overconfidence is through continuous learning and staying informed. You need to do a lot of reading, not just from sources that reinforce your existing beliefs, but also from perspectives that challenge your assumptions. Awareness of historical market trends and the reasons behind market movements can provide valuable insights, and seeking objective advice from a financial advisor also helps challenge your assumptions. A financial education helps you understand how diversification is your friend and teaches you to allocate your investments across different asset classes to reduce risk. By spreading your investments across various asset classes, industries, and geographical regions, you can lessen the impact of one poor performing investments on your overall portfolio. For example, if you invest only in tech stocks and the tech sector takes a hit, your entire portfolio suffers. But if you have a mix of stocks, bonds, real estate, and international investments, the poor performance in one area can be offset by better performance in another. Diversification also includes considering different types of investment vehicles. Stocks, bonds, mutual funds, exchange-traded funds or ETFs, alternatives, and real estate can all play a role in a well-diversified portfolio. Each type of investment reacts differently to economic changes. Stocks might perform well during periods of economic growth, while bonds might be more stable during economic downturns. Real estate can provide income and potential appreciation, and international investments can offer exposure to growing markets outside your home country. Here's how the tech scenario might go differently if you diversify. You'd start by spreading your money across different sectors, and might include healthcare, consumer goods, and energy alongside the tech stocks. Next, you might add bonds or other defensive investments to your portfolio for some stability. Government and corporate bonds can provide steady income and are generally less volatile than stocks, offering some protection during economic downturns. You might also invest in mutual funds and ETFs, which could give you exposure to a broad range of assets. For example, you might choose a balanced fund that includes both stocks and bonds, and an ETF that tracks the S&P 500. To diversify further, you could buy shares in a real estate investment trust or REIT, allowing you to invest in real estate properties that could provide rental income and potential appreciation. Finally, you might allocate a portion of your portfolio to international investments, gaining exposure to growing markets outside your home country. By diversifying across these different investment vehicles, your portfolio could become more resilient. When the tech sector faces another downturn, your losses would potentially be cushioned by gains in other sectors, bonds, real estate, and international markets. This balanced approach helps manage risk and leads to more stable returns over time. Another way to avoid overconfidence is to conduct regular portfolio reviews. Think of it as a reality check to keep you grounded, where you make sure your current asset allocation aligns with your current risk tolerance and your current investment goals. Also consider your current personal assumptions and biases. We all have them, and adjust as necessary to ensure your portfolio remains diversified and balanced. Another practical tip to combat overconfidence is setting specific, measurable goals to objectively track your progress. That way, you get a clear picture of your performance and can adjust your strategies as needed. Also, try to consider the worst-case scenarios and plan accordingly. Preparing for various outcomes helps you temper overconfidence by reminding you that life is full of surprises. The next thing to watch out for is anchoring, which is when we rely too heavily on the first piece of information we encounter. Here's an example of how that might look in an investment scenario. Let's say you bought shares of a company at $50 a share. When the price dropped to $30, you refused to sell, convinced it would rebound to the original purchase price, but it didn't. You might have been influenced by the initial success stories you heard about the company, so you kept believing it was just a matter of time before the stock rebounded. Maybe you ignored negative news, information, or analyst reports suggesting that the company's fundamentals had changed and the industry faced significant challenges. So as the stock continued to decline, you not only kept losing money, but you also missed opportunities to invest somewhere else. The point is that you can't let an initial impression keep you from adapting and moving forward. You have to update your reference points with new, relevant information. Objective, data-driven analysis, not gut feelings, should guide your investment decisions. And setting realistic expectations for returns and overall investment performance can help create a more balanced understanding of potential outcomes. Another practical approach is to establish clear, predefined criteria for when to sell an investment, which can help prevent emotional decision-making based on initial purchase prices. Regularly reviewing and updating your investment strategy can also help ensure your decisions are based on the most current and relevant information. Having the external perspective of a financial advisor also helps you see beyond initial anchoring points. The final aspect I want to talk about is confirmation bias. This is the tendency to seek out information confirming our existing beliefs and ignore anything that contradicts them. It's often why people cling to failing investments, convinced that things will turn around. Confirmation bias in investing is like only reading the 5-star reviews of a restaurant before you visit. It makes you feel good about your choice. But if you skip warnings about long wait times or mediocre service, you're going to be unhappy in the end. Only reviewing supportive feedback and ignoring critical insights can lead to a disappointing result during a downturn. Confirmation bias can also come into play in political investments. It's natural to favor companies or industries that align with your political beliefs. But be careful not to ignore financial data that contradicts your preference. For example, imagine you're convinced that renewable energy is the only future for the energy sector. While it's true that renewable energy is growing, completely ignoring fossil fuels and other energy sources can be risky because of the volatility associated with that sector. You can and should consider personal beliefs when investing, But be sure to do it with your eyes open so you don't miss out on potential gains in other sectors due to a narrow focus. I'm not saying you should invest against your beliefs. It's more that political beliefs alone are not a good foundation for investing. One way to counter confirmation bias is to actively seek information that challenges your views. Follow news sources, analysts, and thought leaders with differing opinions. This can provide a more balanced perspective and help you make better informed decisions. Using technology and tools can also help prevent confirmation bias. Investment analysis software and financial news aggregators that present a wide range of viewpoints help provide a more balanced view of the market and specific investments. Now, you might also be wondering, Keith, can a financial advisor help me avoid these pitfalls? Great question. A good financial advisor tells you what you need to hear, not what you want to hear. They provide objective, data-driven advice and challenge preconceived notions. They don't just give you an answer. They provide an answer supported by reason. Investing in a bubble can be dangerous, and an outside perspective helps you make more rational and informed decisions. That pretty much wraps up the discussion for today. We've explored the concept of cognitive biases and their impact on financial planning. We discussed 3 common biases: overconfidence, anchoring, and confirmation bias, and provided real-life examples and mitigation strategies. It all comes down to an awareness of how our brains process information. Cognitive biases can be helpful when making quick decisions in everyday life. We need those mental shortcuts sometimes, given our endless daily choices. But when it comes to financial planning and investing, these biases can be a blind spot and really trip us up. Overconfidence can lead us to take unnecessary risks. Anchoring can keep us stuck in the past, and confirmation bias can blind us to reality. Start by recognizing that these biases do exist and act accordingly to set yourself up for financial success. Thanks for joining me today, and if you found this topic helpful, don't forget to like the video and subscribe for more insights on financial planning and behavioral finance. You can also leave a comment or share your stories below. Remember, managing your mind is just as important as managing your money. Be a savvy steward. Make your life count.